Hello friends, I again welcome you to another exciting and interesting topic on the Tarakki Times, uh, Tarakki Talks I should say. And of course, over the last 6 months to 8 months, whatever interactions we've had, they've been in market times where a lot of global liquidity has helped the markets to do well. Across sectors, across stocks, the corporate results, the corporate profitability numbers have been supportive of this market rally. And hence, from a global and local perspective, investors are finding it a bit difficult to figure out whether this will sustain, whether this will go on. Our belief is that from an investor perspective, the first thing that you should always do is to ensure that you have your asset allocation mix right based on your risk profile, right? And it's not something which is taught to all of us, right? What is the risk profile that I carry or you carry has not been taught to us in school, but it is very important, and that's where the role of a financial advisor becomes exceedingly important. We probably underestimate the role of a financial advisor in our life, but it is very important to have a very sound, intelligent financial advisor, especially in the current times where a lot of things are leading to global markets and local markets being impacted. From an investor perspective, of course, we believe that if your asset allocation allows investing in equity, the core portfolio for you would always be the dynamic asset allocation fund category. But if you want to build on that, and many investors are looking to diversify and invest for the long term, especially the younger investors, the more savvy investors in terms of technology, and they may not have too much money, but they want to save and they want to invest in Indian equities. And that's a culture which probably is also getting reflected from the West, where equity as a culture has been a big culture for long. So from an Indian perspective as well, we are seeing equity culture develop, which is a good thing. The number of demat accounts going up is always a positive from a company perspective. And we participating in the growth of our own companies is probably what we should have been doing for a long, long period of time. But I'm glad that it is happening right now. So from an investor perspective, like I said, you may need a lot of investment solutions. And we at ICICI Prudential Asset Management Company want to ensure that all investments or all categories where you would want your financial investments, we should have a product for you, we should have a solution for you. The passive fund industry is growing. We've seen in the last 3 to 4 years a lot of investors being interested in investing in passive funds. Passive funds include index funds and ETFs, and it is a global phenomena as well as it is increasing in India as well. So most investors want to have a mix of active and passive funds being managed by fund managers, and also funds which are tracking an index. And with that thought process in mind, we also have a bouquet or a suite of funds across market cap oriented and sectoral themes. The topic of discussion today is a very interesting topic. It is essentially the launch of our NFO of ICICI Prudential Alpha Low 130 ETF FOF. It is a fund of fund, so it does not need a demat account. It is a fund of fund structure. And of course, before I move on to the fund and its specific itself, I would like to first highlight what is the meaning of smart beta, what is the meaning of factor-based investing, and why it is important for all of you to basically have a certain allocation to factor-based investing strategies. Essentially, if we see over a long period of time, if a particular factor is basically used to select a set of stocks and you keep applying that factor for long periods of time, in general, because over a period of time the strategy works, you end up getting the benefit of that particular factor doing well. What are factors? The factors essentially are either price-based factors or fundamental factors. In other words, to make a portfolio, I can choose to have dividend yielding stocks. I can choose to have those stocks which have high growth in terms of their profitability. I can choose to have those stocks which are high quality in terms of, let's say, their return on capital employed, return on equity, that is their profitability matrix. I can also have those stocks which are value oriented, which is lowest P and PB. And more importantly, in the Indian context, we've seen and also abroad, that there are two factors which in general should be a part of all investors' portfolio when they're looking at factor-based investing. The first factor, of course, is low volatility, and the second factor is alpha, or essentially returns. And the NFO of the fund essentially, of the ETF which we are going to be basically investing your money in, is essentially built on these two factors, which is alpha and low volatility. So the concept is very simple, that the fund of fund, which is the new fund offer which we are bringing to you, is going to be investing in the ETF of ICICI Prudential Alpha Low Vol 30 ETF. It is a ETF which was launched in August 2020, and it essentially is the first multi-factor smart beta ETF which is there in India. It chooses 30 stocks out of total 150 names, that is 100 in large cap and 50 in mid cap. And the 30 stocks are chosen on the basis of factors, these two factors, which is alpha and low vol. What is alpha and low vol? I'll just explain in very simple words. Alpha is nothing but the returns over the last 6 months and 12 months. In other words, those companies which have done better or performed well over the last 6 months and 12 months, they get a higher ranking. And low volatility essentially is those stocks which have been stable over the last 1 year as calculated by the statistical metric of standard deviation. Now, of course, I'm not going to go into the statistics on a long weekend, but I would basically like to tell you that low volatility as a concept, it essentially brings in a set of stocks which have had stable performance. And when you combine these two, which is alpha and low vol, the returns and stability, if you combine these two particular aspects of alpha and low volatility, in the long run, you will find that you have a portfolio which tends to capture the market's movements or the market's growth reasonably well. And as a factor-based investing, we feel that this will be a good fit for the long-term portfolio of all investors that are looking to invest in fully invested funds. The advantage with the fund of fund structure brings to you is, number one, it continues to be equity taxation. So a fund of fund which is investing in an underlying ETF, because it is having an underlying ETF minimum 95%, the taxation for this fund of fund would be equity taxation. So that is the first advantage. The second advantage is of low cost. So relative to active funds, the smart beta strategies on the passive side have lower costs. And third, if you look at it from a investor perspective, you may want to do SIP, systematic investment plans. You may want to stagger your investments over a few weeks, few months, and that becomes very easily possible through the fund of fund route, because it is just like any other mutual fund, how you can invest through the systematic investment plan route. So the fund of fund does not need a demat account and trading account because it is a mutual fund. So compared to an ETF, that is the advantage that you get. In a fund of fund, whenever you invest money, you will get the day and NAV of that fund of fund, unlike in an ETF where you can basically trade intraday as well. So from a fund of fund perspective, while it is very easy for you to invest, you should remember that what is the underlying of this fund of fund, and the underlying of this fund of fund, which is the NFO which we're talking about, is a smart beta multi-factor strategy called alpha low vol. As I've already explained, these two factors in terms of their past history, if we see, they've done reasonably well for the investors. And while we cannot predict whether past will happen in the future, the logical methodology of this particular index is such that there are many checks and balances built in from a risk metric as well. So let's look at what are the checks and balances from an index constituent perspective. So like I said, the index is made up of 30 stocks. These 30 stocks at the end of every 6 months get rebalanced by the index provider, which is NSE indices. They basically bring out what should be the rebalancing, and we in turn then execute that rebalances on behalf of the unit holders. And if you look at the 30 stocks, they are picked up or they are selected on the basis of these two factors, which is alpha and low vol, the combination of these two. So these are not the stocks which have the highest returns. So it's not like we are picking 15 stocks which are highest returns and 15 stocks which are highest, let's say, or the lowest volatility, or have been the most stable. It is a confluence of these two factors, which is alpha and low one. So essentially, those stocks which have done well but have stability as well as part of their overall. So the ranks essentially for these two are totaled up, and the sweet spot in terms of those stocks which have given returns and yet have been stable, they basically are chosen. Today, if we see the composition of the index, it has about 40% in consumer names, because in India, consumer names and the consumer story is something which is strong. All of us will agree that in terms of demand for consumer goods and services, it's basically going to be strong, and it's going to only increase as our middle class population grows from current levels, and also as our per capita income and our as a country we become richer than what we are. So the consumer names are there at 40% of the overall of the portfolio currently, and then you have information technology as the second largest sector at around 18 or 19%. But obviously, like I said, every 6 months the portfolio keeps changing depending on which are the stocks which have exhibited these two factors. So it is the factor which in the methodology becomes extremely important. We have a built-in safety net of no single stock at the time of rebalancing being more than 5%. So you don't have a single stock which will be more than 5% at the time of rebalancing. And also these stocks are chosen out of the derivative universe. So they are liquid stocks. So predominantly large cap liquid stocks with 5% cap. And like I said, universe is top 100 names in large cap and 50 names in mid cap. So generally, if we see the trend, it is a large cap tilt. So all in all, from an investor perspective, while the whole smart beta concept, while the whole passive investing would be new to all of you, we at ICICI Prudential want to ensure that we are able to bring to you the right product and which will suit you for the long term. And also, of course, from your overall allocation perspective, we believe this is a good fit. If there are any questions, of course, please feel free to write it down on the chat box, and I will be happy to elaborate on the questions as we move along. I'll take help from my colleague to basically send those questions to me at the end of this talk. But clearly, from an India perspective, if we see, we are seeing people getting interested into investing into passive funds, and index funds and ETFs are very easy to understand because you have a particular benchmark index, you have a methodology. So you exactly know what you're going to get in terms of number of stocks, in terms of sectors, or let's say in terms of the factors which are there. So a bit more predictable. They are transparent. Every day there is or every month at least you'll know what the portfolio is made up of, because that comes in the fact sheet. And also from a cost perspective, they are relatively low cost. So you get the benefit of essentially having 3 or 4 advantages built into index fund or an ETF. And within that, the smart beta factor is something which is catching up. Globally, if we see, of course, the dividend yield as a smart beta factor has worked very well and has garnered a lot of AUM, because globally interest rates are close to zero. So higher dividend yielding stocks have generally been preferred by investors. And so if you make a portfolio out of higher dividend yielding stocks, that's basically picked up globally. In India, dividend yield as a factor is not so strong. So which factor works in India, which factor is, basically fit from an Indian context also matters. And hence, from a chronology perspective, we felt that the alpha low vol as a strategy is something which fits India well, the Indian circumstances well, and the way we've seen the portfolio change in the index change, or the changes which are happening in the index, it gives us confidence that the index is able to maneuver itself enough to be able to capture the essence of the market in terms of those stocks which have delivered returns or have delivered returns in the past and are looking and are stable. And there is a chance that they continue to do well. So from an investor perspective, we believe this is a good fund, the ICICI Prudential Alpha Low Vol 30 ETF of FOF and FO. Like I said, it's a fund of fund with equity taxation. So from your perspective, that does not change, and it is very, very easy for all of you to invest. The NFO closes on 15th of September, and the minimum application size is rupees 1,000 for those who are investing afresh. If you're switching, of course, it is rupees 500. And more importantly, it being an open-ended fund, you can basically come in and get redeem or subscribe as and when it reopens for subscription and redemption. So it also allows you to take advantage of the markets should the markets come down. So it's not like markets will always have a straight line up. For the last 18 months, we've probably been spoiled by the fact that markets has had a rally which has never, it's almost unprecedented. And many stocks have kept on multiplying or have done well. And many of the investors have also started to probably invest directly into the market because they feel that it is probably easy to invest in the markets and make money. A word of caution there that if you're investing directly in the markets, you need to do a lot of research. You need to know about the companies. By luck, by chance, you may have made money in stocks which you probably don't even understand. But that's how you also end up losing. And we've seen that happening enough in India in the last 30, 40 years, that whenever there's a bull rally and it is followed by a cyclical correction in the markets, because most investors don't necessarily understand the stocks that they have, they end up selling those at the bottom of the market. So to avoid this tendency, it is important to basically check yourself and have a good mix of professionally managed funds being invested, which is essentially a mutual fund. And also, when you're investing directly, a word of caution that it can also hurt if you basically don't have your checks and balances in place. So it is good to learn, it is good to assess, it is good to basically do your own research and invest. But if you don't have time to do that, you're best off basically allowing your money to be with professional investors or professional fund managers to do the job for you. And the last thing which I want to say, of course, is that please keep your asset allocation in mind at all points of time. And within the asset allocation, if you're looking at increasing your equity exposure, we believe the ICICI Prudential Alpha Low Vol 30 ETF FOF and FO, which is essentially the fund of fund, will be a good fit for your long-term investment portfolio. This is a fund of fund which is based on the two factors of alpha and low vol. These are not tactical factors. These are long-term factors. And this is not meant to be a fund where you invest today and in 6 months you basically take out the money. That's not the objective. The objective is that it's part of your core allocation for the long term. And we believe that as India keeps growing from a $3 trillion to a $5 trillion economy, you would want to participate in the companies in India which are basically taking advantage of this growth and growing along with India's growth. And to an extent, we believe that the sense will get captured in this fund of fund NFO. So with that, probably I'll stop and I'll see if there are any questions. We'll just probably wait for about 20 to 30 seconds and see if there are any questions. Okay, there are a few questions on the fund itself. What is the expense ratio of the fund of fund? So essentially, and it's a good question, so thank you for asking me the question. So the expense ratios are all within the limits laid down by the regulator. As far as the fund of fund is concerned, since it is feeding into the ETF, we do not want to basically charge a significant amount on the fund of fund itself. So we try to keep it as low as possible from a fund of fund perspective, but it is all within the regulatory limit as far as the expense ratios are concerned, and they will be available in terms of the exact numbers for the expense ratios will be available on the websites and the literature which is there, which will come out. The next question is, could you give names of one or two companies where funds will be invested? Sure. So the question is, and I repeat that, could you name one or so essentially, this is an index fund and the ETF is already there. So we already have the entire portfolio, in fact, in front. As on the month end, the previous month end, if I remember correctly, the 40% which was in consumer names. So you asked a few names which are there. Names like, let's say, from a technology company perspective, there is Mindtree at the top, then there's Dabur, then there is Hindustan Unilever, there is Nestle, there's Marico. So these are the names which are there at the top. So those companies which have given returns and have been stable are part of the portfolio. The fact sheets are available on our website of the underlying ETF, which is the ICICI Prudential Alpha Low Vol 30 ETF. The methodology is available on the NSE Indices website as well. And if we look at the presentation of this particular fund or NFO itself, it does give out the top 10 names and the sectors itself. But in general, like I said, because these are the large cap companies with derivatives or underlying derivatives, which are there, which is futures and options in those companies, these are liquid names, household names, which you and I can relate to. And that makes this product very relatable also as an investment avenue, because most of the companies which are there will probably be able to relate to it. I think even Colgate is there, if I remember correctly. So Colgate, Hindustan Unilever, Nestle, Marico, and at this juncture, I'd also like to say that while today the markets are such where the consumer names are high in terms of their returns and stability, it's not always that we have 40% in this particular ETF in consumer names. So it is dynamic. It keeps changing based on the market. The only thing which basically is used for the short listing is alpha and low vol as two factors. Based on these two factors, whatever stocks get chosen, the sectoral allocation and the stock weight are essentially a byproduct of the stock selection. So unlike in a normal index or an ETF, which is market cap based, even the weightages of these underlying stocks are based on the factors and their factor scores, which essentially also makes this a good product, because it's not necessarily that a large company has a large weight. It's basically based on the scores of alpha and low vol. So if it's a company which has given good returns and has been stable, then it basically gets a higher weight as well. And so it's a very interesting concept from an investor perspective. The next question is, can you explain what alpha low vol means? Sure. So that's the essence of this particular product. Alpha and low volatility. So alpha is essentially a measure of performance of those stocks. It's essentially a ratio or a term. It's a numerical number which basically gives you the fact that how much has a particular stock done better than its benchmark, right? So that's essentially alpha. Alpha in general terms is how much better has a particular stock done compared to what its benchmark has done, right? So if you look at, for example, the Alpha Low Vol 30 ETF, the stocks in the particular portfolio would have probably done better than their peers. So you rank those stocks, which are the universe stocks, and you see which have done the best in terms of performance. So, and if you compare it to the average of the performance of all the stocks which have done the best, so the difference between a stock's performance and its benchmark performance is called the alpha. It's a numerical measure. It's essentially a factor. And low volatility, which is another factor. It's a statistical factor which brings out what is the standard deviation. When I say standard deviation, in simple terms, in simple parlance or common man's language, it is stability. How stable a stock has been. The calculation of low volatility is very simple. Again, no statistics lessons, but just for those who have academic bent of mind. If a stock has, let's say, 30 days and it has moved up 2%, down 2%, then again 3% up, there's an average or a mean which we calculate, right? So for those 30 days, what is the mean? And the difference from the mean of each of these days, if you square, and you get the basic standard deviation of that particular. So the higher the difference from the mean. So if a stock has been more volatile, so a stock which has basically had +1, -1, +1, -1 versus a stock which has had +3, -3, +5, -4. So a stock which has moved a lot or has been more volatile on a day-to-day trading basis, while a stock which has been more stable. The low volatility factor will basically give a higher weight to those stock which has been basically more stable. So it's a measure of how stable a stock has been, how low the volatility of that stock has been relative to its mean. And so from a alpha low vol, that the question was, what does alpha and low vol mean? Alpha and low volatility both are factors. The similar factors are dividend yield, which is a factor. Quality, it's a factor. low price to earnings is a factor. Price to book is a factor. So there can be price related factors, right? There can be RSI, MSCI or relative strength index. There can be price related factors and there can be fundamental related factors. And there are many factors. There are maybe 50, 60, 70 factors which are possible from a mathematics perspective. But the ones which we believe have a good correlation and relevance are alpha and low vol together. You also have alpha, low vol, quality, etc., which are potentially possible to create together. So the more the factors you put together, ultimately you're nullifying each other's negatives and probably adding to the positives. But that's where you come closer to the benchmark index, which is essentially Nifty itself, right? So if you combine all the factors, ultimately you may probably be closer to the Nifty in terms of the thought process. So alpha and low vol are two factors. I hope I've been able to answer you well. For those who want more deep dive into the subject, there is a white paper also on the NSE Index website on the concept of alpha low vol. I think if you Google it, you'll probably find it. White paper on this particular index, white paper on alpha low vol 30. And it has all the description of what is it all about, how it has done in the past, and what are the key contours of this particular index. So I think there are no more questions, but and also we are, I think, running out of time. So thank you for your patient listening. It is a subject which is new. It is a subject which needs understanding, which is smart beta. But to demystify it and simplify it, I tried my best. It is essentially very simple. It's a passive fund or an index fund where the fund of fund is investing into a ETF. So this particular NFO is of a fund of fund which is investing in an ETF, which has underlying stock selection in that ETF based on two factors, which is alpha and low vol, which is what I've tried to do. Alpha is essentially those stocks which have returns which are better, and low vol is essentially those stocks which are stable. If you add these two, stable is a let's say from a statistical perspective, stable may not be the right word, but just to make you understand in common language, these are stocks which have moved lesser, which have moved lesser over the last 1 year. So the time period for calculating volatility is last 1 year. So going forward, we believe that as the investors invest and whenever there's a market correction, if you add more, in the long run, this will be useful to capture the journey of the Indian markets and its upside. Thank you very much for your patient listening. It's always a pleasure to connect with you, and thank you for your questions as well. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.